Okay. All right. So a few people still refreshing themselves, which is what you need for the final leg of our marathon here. Also welcome back to those on the web. And now we have actually a world premiere for you. Many of you have heard of the legendary Thorsten Langheim, but few of you have actually seen him. He really exists as the who of global telecoms. So it's a huge pleasure to welcome him. He runs our group development department. He looks after some very exciting assets like the towers, like our global portfolio that includes T-Mobile, BT, and he also looks after the Netherlands. So Thorsten, stage is yours.
All right. Good morning or good day to all and everyone. It's a pleasure for me to speaking to you today, although I'm scared to death. This is something when I joined Deutsche Telekom in 2010, I negotiated with Tim and the board that I never have to do this, and finally I'm here. But the good thing is I only have 2 slides for you. Because you get the key messages on this slide here, and then you know what group development is about. And then I just leave you with this one here, and just look at it, and I'm now open for questions. I think that says it all from my perspective. Gives you the picture of the moment when we in the T-Mo US boardroom approved the transaction. You see all the guys that were very instrumental and important for the deal. You see Mike, you see John, you see Tim, you see Thomas, you see Braxton, and you obviously see some of the headlines. It's a monumental deal for us, and it's as Tim has said, he has worked on this for 7 years. I think we have been constantly in deal mode on this one. We had a lot of discussions in the past, and I'll come to that in a second. So what is group development, and why am I presenting here today? It is kind of a very important group within Deutsche Telekom, which was in existence already since 2010, but it had no assets at the time. So the middle part, the M&A and portfolio management, is obviously the heritage of what we are doing here. We are the guys that have the same DNA like you. We are in this for some reason together, whether you are an equity analyst, a sell side, buy side, or a specialty sales guy, or an investor. And that's also the reason why I like to be here today, because I think I'm talking to myself. Because what do we enjoy? We all enjoy a few things, which is predicting the unpredictable. What I mean by that is we have a tough job, haven't we? Who in this room at the beginning of this week has predicted that the Altice stock price is increasing by 50%? Who in the room has predicted that the T-Mo US share price, based on the announcement of our transaction in the US, goes from $63 to $56? Who in the room has predicted that after the wonderful year 2015, when we all enjoyed kind of 7.5 times EBITDA multiples for MNOs, that we are now at all-time lows in 2018. So I think we share the same depression. We may read the same things in the morning, whether it's Keval Patel or whether it's Mandeep. That's the first thing that I need when I wake up in the morning to read a little bit about the sector and to be cheered up that Mandeep, since February, March, thinks that we've hit the bottom. So that's the reason why I like to be here today at the first instance. The same DNA, which I said is group development, is all about the stuff that you are doing on a daily basis. It's about capital allocation. It's about risk return. Because I have, to a certain extent, provide the analytic framework when these gentlemen that are very powerful and they are very convincing, arguing that they want to get the extra euro or extra dollar or extra pound invested in the company, and we have to make sure that this is not on a first comes first service basis, but that the risk return works out for us, because we have many opportunities to invest, and actually we have, as you've seen, invested a lot of money. So this is about risk return. But I also try to bring something to DT, which you learn when you are working on the private equity side. These guys are not smarter than corporates. They are smart, absolutely, but they have one toolkit that is always working, which is alignment of interest between a shareholder and a manager. And so what we are trying to do here is to create this alignment of interest. And so you will hear me a lot of times saying something like share the gain and share the pain. You will hear me talking about someone needs to have skin in the game if you want to invest. And that is what this group is about. We are, as you see on the left-hand side, we are responsible for our investment management, which can be sometimes more active or less active. Of course, in the case of BT, we are just a small minority shareholder, and we monitor and observe. In the case of T-Mobile US, we are the controlling shareholder and very much focus on capital allocation, how it fits to our own dividend policy and our own leverage, and of course M&A. And sometimes we are also very active managing our assets, as in the case of Deutsche Funkturm or T-Mobile Holland. We actually act like a private equity firm within Deutsche Telekom and carve these assets out to have a different steering applied and to create alignment of interest between someone who wants to see a return on this asset and the managers that are running these companies. And I will explain in a second what I mean by that. And then on the right-hand side, you see we are also responsible for Deutsche Telekom Capital Partners, which is much more than just our venture capital investment firm. It is investing in special situation. It's a governance harbor for some of the growth assets that we have. And everybody here in this room remembers and knows how challenging it is for a traditional telco to invest in tech. We have seen a lot of headquarters in London focusing on technology, on OTTs, investing in this area. And so this is one part of us, next to what we do in-house, is using DT Capital Partners as a hedge for our traditional business, investing in stuff that you usually as a telco manager don't really understand, because they have different characteristics if you, for example, would acquire an asset in the OTT space. Of course, we are proud that our portfolio management has worked. And as you know, as an investor, you need to be more right than more wrong. And hopefully you are more right on the stuff that matters and more wrong on the stuff that is smaller and doesn't really matter. The key thing on which I personally spent most of my time over the last 7 years is certainly T-Mobile US, and the success not only on the operations but also on the shareholder value speaks for itself. I don't think that you find in the telco industry any other comparable case that has generated this amount of value for us. And then obviously on the other hand, let me be frank and open, you sometimes make mistakes. And as I said, we are in this together. I've seen a lot of very smart investors in London, and we got it wrong on BT, of course. I'm happy to answer a few questions on this at the end. On the other hand, also look at two smaller assets, not significant in size, but very important for us if we have embarked on this huge investment program over the last 3 years. As Tim has said, we are very convinced that we need to invest in convergence and that we need to have investment in our networks. And as Mike has said, or Neville, we've invested alone 40 billion in the US. How have we done all of this by, at the same time, keeping our rating in place and keeping an attractive dividend out there? Small divestitures like Scout and Strato also played a role in this. Keep this in mind. In 2012, the management team of Scout wanted to do an IPO. We had about 100 million of EBITDA. bankers were pitching 1.2, 1.3 billion. At the end, with hand-holding by DT Capital Partners, by the team, we generated 2.6 billion for an asset that had 100 million of EBITDA in 2012. Same story on Strato, which we took on in 2014, where we generated 700 million of proceeds. Overall, kind of 3.3 billion, 450 million of EBITDA. There's 20 times EBITDA, and that helps you a lot on your balance sheet. So this is a little bit our track record, and let me explain a little bit the T-Mobile US story. I don't want to bore you on the whole story again, looking back into the history, but it's important to understand how we approach our portfolio and how we look at it. It gives you a glimpse how we may act in the future. Keep in mind, I remember when I joined in 2010, 2009 at this time, there was a famous annual shareholders meeting at Deutsche Telekom when Mr. Kaldemorgen of DWS said something really right. He said, the biggest overhang on the Deutsche Telekom stock is T-Mobile US, and I have no idea where you guys want to take all the money that is required in order to invest in your company. Keep in mind we lost 2 million customers. Keep in mind that we had the weakest network in the US, and keep in mind there was no path for us to get to the damn spectrum that was needed in order to improve our network. So what did we do? We tried to sell it, and obviously we picked the best horse with most of the synergies, which is AT&T. Now you can say in hindsight, oh my God, I'm very happy that this hasn't happened because we got a break fee, the famous 3 billion cash break fee, but what was much more important than the cash, it was a mid-band spectrum that we got in order to improve the network. We love the US for one reason, for many reasons, but in particular for one. If you have spectrum in the US, you have it forever. There is not someone coming in 5 years and says, oh, by the way, we want to re-auction the spectrum, and there is a new fourth entrant that gets that spectrum almost for free. Not happening in the US. So we got this very important spectrum, but we had one problem. We hadn't had the money at Deutsche Telekom. We are always close to our rating band. We have a lot of investment needs. We have a very broad portfolio. So we did something which I call self-supported scale. Internally, we use the word de-risking, self-funding, kingmaker asset as a kind of mantra for us. So obviously, we used the break fee, we used the spectrum that we got, we sold our towers for 2.5 billion, and then we did something which you see as a kind of DNA of, or the M&A playbook of Deutsche Telekom, which is the reverse merger into Metro PCS. Why is it our M&A playbook? Why are we doing transactions these ways? You see EE was contributed to BT. You see, again, a transaction that's happening right now where we are not coming like Comcast with a huge bid cash for an asset. We put it together for two reasons on this basis. And by the way, Tele2 and T-Mobile Holland is exactly the same. I would have loved that Tele2 is a listed business. It's not, but it's all about predicting the unpredictable. We want to have risk sharing. We want to share and be equally happy and equally unhappy if you do a deal, because you may wake up in 2 years' time after a deal, and you can do whatever you want to do on due diligence. Nobody is foreseeing that Ofcom is starting a war with you. And that is the tricky thing here in the telco industry. You cannot, like I'm used on the private equity side, predict cash flows. It's really a difficult thing. On the other hand, we are in an industry where we have to invest a lot of money with a payback sometimes for 30 years. So M&A playbook, we did the reverse merger into Metro PCS. We kept the money in the company. And what was very important, and nobody really picked this up, it's kind of funny if you look at MNOs, you're kind of hooked up on dividends, aren't we? We are just looking at it. What is the dividend? What's going forward? It's interesting to see that I'm coming from an industry which has been kind of labeled as short-term. I think the capital markets are currently very short-term, of having very short-term perspectives of things that are happening. So you have to pay a high dividend, but can you imagine that we would have done a major turnaround in the US and we come from 106 billion of free cash flow. Even in the worst years of T-Mobile US, the company generated about 1.5 billion of free cash flow, even more so when the customers were fleeing, and saying then to the market, oh, by the way, in 5 years, it will all be better. The interesting thing is, if you have a public listed company, for example, if you look at the TDC case, the stock price is inflicting the minute when the decline in revenues decelerates. And the big benefit that we had in the US, because all these guys are fighting for money, for capital allocation. The big thing that was helping us in the US to have confidence in investing more despite having negative free cash flows for years in this company was that the market understood what was coming. Stock price was increasing, gave us more confidence to invest in the US, and then that allowed us between 2013 and 2017 to invest about 15 billion alone in spectrum. And that's Mike. Mike is absolutely right. I don't get the $56. What a wonderful asset that is. We just bought 8 billion of low-band spectrum, and we just got much more spectrum than we ever thought on the basis of this price, because we got lucky in terms of timing. The big guys weren't really there. And this is beachfront property for generations to come. So significant investment program, and where we are today with this wonderful asset. Yeah, you can be, you basically have, in my view, so I just say that for me this is a $70 stock right now, with a free option to a much higher value if the deal is going to be approved. And that's what we have. And I don't understand why the markets are valuing it as they are valuing it. That's what I mean with kind of short-termism. Nobody wants to wait for 12 months. It's kind of, oh, it's dead money for some period of time. We have everything in place. We have shown to investors, to ourselves as an investor in T-Mobile US, that the capital allocation policy of this company, moving from a high-growth stock to something that is generating returns for shareholders, not only on the stock price, but also on rewarding shareholders via share buybacks or maybe in the future dividends. It's already in place. 9 billion is coming in our way, and that's the reason why I like this company so much. Tell you a little bit about the story behind it. That's my favorite one over the deal, Ross and Rachel. It's kind of funny because this is now, today it's called Big Bang Theory. Only the people that are over 50 like myself still recognize that. But Ross and Rachel is T-Mobile US and Sprint coming together. I remember when I joined in 2010, I had two discussions at the time. One was with AT&T and the other one was Sprint. They were unrealistic in their kind of value expectations at the time, so we took the deal with AT&T. But I can tell you how many times we had affairs in this period of time with each other and with others. This is kind of mind-boggling. I think the reason why I look much older than I am is actually that I think since 2014 I have worked tremendously on M&A deal situation. This is Ross and Rachel today. You can pick who you want to say is Ross and who is Rachel. In the middle it's Joey, quite clearly. How are you doing? Yeah. So this was on the day when we announced, when we agreed on the deal on that Friday before we announced it on Sunday. And obviously at that time subject to board approval, and one of my favorite pictures. One thing about capital allocation on our side, we can be patient. We don't have a 300-year plan, but we have a plan. And sometimes, as you know as investors, it's the best deal that you do is the one that you don't do. Obviously, we have been approached many times on this asset, and we said no. My favorite one last year, and that's the reason why I'm not really like too much being on stage, is when you basically read in the press or on Twitter that you are about to board a plane to Tokyo, which happened in November last year. While Tim, Thomas, myself, we have not even booked the flight yet, saying Deutsche Telekom flies to Tokyo to safeguard the deal. Yeah, so it is a little about the publicity and how much we have worked on the deal. It's clearly that the operational success has delivered the value success, and I think what is important to see, we moved from a kind of minority shareholder in this company to someone who was close to 50%, and with the proxy that we get on the votes, we have 69%. But This is not about conglomerate building. The reason why we wanted to be leading this is to have no ambiguity if we want to go for the synergies. No higgle and dime, what is the right brand? Where do we build out the network? Where not? What is the anchor network? We just wanted to have one guy in the room taking the decisions. And then just to have a glimpse on the right-hand side. Keep in mind, it's kind of interesting for me to see over the years, there's a European market with a lot of questions to convergence. And then the question obviously comes up, when is it going to happen in the US? And you don't really see that in the US right now, but what you see in the US is this is an unlimited market where data growth is coming. So what do you want to have in this market right now? You want to have the best pipe. And just look at the spectrum position, just look at branded subscribers. Two things to learn from this. We will have the best pipe, as Mike and Neville have outlined to you. But we will also now finally, if this deal is going to be approved, overcome one of the biggest issues that we have in a 350 million pop market, which is scale. Our margins are, of course, much lower than the bigger guys. It's like as you know, it's like a jumbo. You service the same, but if you only have 40 customers instead of 100, it depresses margins. And then just have a look at market cap, which may tell you that, oh my God, why should this company have a market cap on a combined basis of 72 billion while the two other guys have this amount of market cap? It's not 100% analytically correct. As you know, there are some other businesses in there, but it gives you at least a direction that the 43 billion of synergies that we are seeing are really very convincing from our perspective. I also learned one other thing while being an investor. Once in an investment committee, I was talking very enthusiastically about an asset, and then some very senior guy said to me, hey, Thorsten, you cannot turn chicken shit into chicken salad. And you need to be honest if you want to get money. And so T-Mobile Holland in 2016 has not been a chicken salad. And we want to be open about this. This is a very difficult market. And we had the triple whammy at the time. We lost customers, so volume was going down. We tried to recoup it via price decreases, so ARPU was going down. We had a fourth entrant, also contributed to it. So we lost market share and we lost profitability quite significantly. And this was also the time to add insult to injury when we tried to sell the company, because this is a mobile-only market that is fully converged, doesn't fit into our long-term strategic beliefs, and we couldn't sell the company for a decent price. So at that time, the board asked me whether I could take on responsibility for that. And I said, yeah, I love it. I said, no, I didn't say I love it, but I said, okay, we need to apply a different toolkit here. And let's run this as if we own it to the kind of price that the private equity firms in 2016 put on the table. Let's create alignment of interest with the managers. We have an equity incentive scheme in here, but again, keep in mind, share the gain, share the pain. There's one other sentence that people always forget. In order to share the gain, you have to have skin in the game. We have 125 people in this company that have invested in it, and they will lose their money if we don't achieve a certain valuation, which is basically the valuation that we got on the table from PE plus a capital charge for managing this company, because it's capital that is allocated to these managers. On that basis, kind of interesting, you get a lot of good guys on board, because there are a lot of people that want to be working entrepreneurial and they want to put their money where their mouth is. And so we got a new team in there. We obviously, in this market, looked at our competitive advantages, disadvantages, and we went unlimited. Obviously, cost cutting is much easier said than done, but if you have a team that has stakes in the company, this is an easier discussion that you have, that I've learned on the PE side. And the most important thing that we did was, obviously, we de-risked our unlimited strategy with a capacity outsourcing deal, a capacity improving outsourcing deal with Huawei. They took this as a big chance and said, oh my God, we want to do this, we want to show DT what we can do, and that gives us a very good pipe. In fact, we won the network test for the last 2 years. In fact, I think we have been ranked as the best EU network just recently. You also see that we apply our M&A toolkit. So we carved out the towers. Very important, they are not part of the deal with Tele2. There is a lot of value arbitrage. There are a lot of guys that are very eagerly looking to acquire Dutch towers, and we have this put aside. We acquired out of the Vodafone-Ziggo transaction a few fixed assets, and we now have 200,000 customers on it. So where are we today? I would say we have been on intensive care, and we are now at rehab, but we are not out of the woods. We won the last 6 quarters. Keep in mind, there's a lot of people mix it up and say, oh, this is like T-Mobile US, a challenger. No, we are actually a premium player in this market. We have to protect our back book, and the market structure is obviously quite different to the US. But as Srini is absolutely spot on, you initiate a turnaround not by just cutting costs and hoping the EBITDA will save you. You have to work on your top line, and that was what the team is doing. New tariff design, trim up from 62 to 77 points in Holland over the last 24 months. NPS, we are number 2, moved up significantly, and that's where we are. I know that especially Tim got almost a heart attack when we introduced a 35 euro unlimited product. I think the Dutch guys get the best deal in Europe with our network and our network quality and speeds in the whole of Europe in order to regain momentum in this market. Having said that, it's in rehab because the market structure, it's a very interesting case study of looking at it, because it may give you a glimpse of how many markets may look like in the future. So what you have there is 2 players with 90% more than 90% broadband market share. This is a flat country. Everybody is used to take his mobile phone and use the next Wi-Fi connection. It has a very low mobile data consumption despite having the best mobile networks. It has the toughest net neutrality rules. So things like music streaming couldn't get done. And then to, again, add insult to injury, it has most of the highest fixed wholesale access pricing that I have seen here in Europe. That's the reason why we now said, okay, we need to have a creation plan that goes beyond operations. We need to have a market structure improvement, and that's the reason why we announced the Tele2 acquisition in December, and obviously have been very busy on that. Again, same M&A playbook. In the interest of time, I just want to move on quickly. You would say, Thorsten, you are a bad negotiator if I would just have said T-Mobile Holland is our only asset in group development. Of course, I said to Tim, I also want to have a good asset. It's to just counter the hard work on T-Mobile Holland, and I think I got a wonderful asset in this portfolio, which is, as I always say, it's sleeping beauty. It's the #1 German tower operator with 28,000 sites. It has things that we don't see as an MNO. It has no regulation. It has a cash conversion of 80%. It has 60% EBITDA margin, and it has secular growth. And on top of it, if you look at it, I love German engineering. It has a database that is second to none. We know where every tower, not only ours, but also the other guys, are in Germany. It took me 6 months to prepare the tower sale in the US in order to put all the lease agreements together. In Germany, you just put it into a look into a database. So this is certainly a wonderful asset. And there's a huge opportunity also in the European marketplace. You see that it's very fragmented. In the US, there you have a different market structure. And keep in mind that Crown Castle, SBA, these guys have tripled market cap over the last years. So what is the path for Europe? Maybe too early to tell right now, because I'm in studying mood. You have seen that DT Capital Partners has co-invested with one of the smartest and best-run tower companies in Europe, with Cellnex, to acquire Olaf's Sunrise Towers. And we were in there because I wanted to learn from the best and why they are running this so successfully. But on the other hand, keep in mind, this was a service function of Deutsche Telekom, of T Deutschland. And now we've taken it out, or workbench, and this has created, if I put my DT head on it for a second, a lot of good dynamics, because CapEx becomes OpEx. You have to justify, if it becomes OpEx, much more the investments that you are doing. And then on the other hand, TTEGY woke up and said, oh, I'm paying for some revenues or services that I'm not going to have to pay for because I'm not using it anymore. So kind of very interesting thing that is helping us a little bit to increase the efficiency. And this is kind of our plan. So we are now at 2.0, so we have a new team, and this team has been picked with a view of diversifying the revenue stream, of going for co-location much more than we have done in the past, of looking at other opportunities that we have, of building a small cell expertise, of building expertise around e-mobility, which may be part of this asset. And obviously we negotiated with Dirk an arm's length MLA, and that is in place, so we know how we interact with each other. What may come in the future is I'm sitting on 2 other asset portfolios, which is Holland and which is Austria. Let's see what we want to do with that. Maybe we put this all together. We have an e-mobility infrastructure. I'm very excited about that, where we utilize our assets. And the question is, do we want to create a European TowerCo or not? The only thing that I can say today is what we don't want to do at DT is sacrifice our long-term network leadership capabilities in Germany for some kind of short-term value arbitrage. That's certainly not going to happen on our side. DT Cap, a few sentences on this one. As I said, this is much more than you may think a kind of venture capital firm. There's a lot of assets under management. It has already been very successful since 2015. We make money, and it's an autonomous group. Tim is right. The management KG is owned in majority by the management team. Share the gain, share the pain, have skin in the game. We haven't lost money with it. In fact, we've made very interesting returns so far from the exit that we have generated. The portfolio looks good, and it has a close interlink. We put one of our best guys on this in order to make sure that we are going for 2 things that are important for us as DT. We want to have a technology hedge. This guy knows DT best. It's Vicente Vento, my sidekick on the M&A side for many years. He has been an investor, like most of you. He has worked at a hedge fund, and he knows tech. We're investing a lot of money, not only in the company, but also in the people that are working there, because they should understand and develop the credibility and the judgment for us making acquisitions in this area. And the thing that I've never understood is the following one. There were a lot of successful OTTs like Spotify knocking on the door saying, can we have a revenue share deal? This is a team that should look at this stuff and say, maybe we don't do a revenue share, maybe we just take an investment for that. So I'm very excited about that for the following final reason, which is that we just are in the final discussions with someone else who says, I want to give you some more money because you are successful. So we want to build a new fund platform. I don't want to always come to Christian or to Thomas and say, give me more money, because our investment rate is now increasing every day. We have a very successful team that is working in 3 locations. Why don't we have a buy-in venture fund, equity fund of the telco industry in Europe? And you may now ask yourself, well, what does you mean? It's kind of the interesting thing is in Europe, nothing scales. Really, if you build an IoT solution in one area, you may have to go to many different telcos in order to generate something which is more meaningful as opposed to the US where you have 350 million POPs. But we are thinking about creating a fund where other telco, maybe not the ones that are overlapping with us, are also putting some money in, and then we have a bigger scale because we want to do more meaningful investments with a team that is basically measured on the success. Financial outlook, our commitment, as I said, we are representing about 900 million of EBITDA. is we will grow the top line by 3%, EBITDA growth of 3 to 4%. Obviously, we will invest a lot. That's the reason why the cash contribution is shown here on a normalized basis, given that Dirk is trying to defend and build out the network leadership in Germany. But this is one metric for me. The most important one is this one here. And this is my, I call it Bundesliga-Tabelle. This is the one that if I ever would come back on stage, the only slide in 3 years that I want to show you. And then I hopefully have on these red bars much higher values than today. That's my commitment to you. That's my commitment to the board to work on our portfolio and to increase the asset values as we have done in the past. Thank you for not booing me from the stage. I'm open for your questions.